Imagine a proposition for a second. Uh, I'm going to hand you $200 in cash right now.
Okay.
You can just keep it, no questions asked. But in exchange, you must agree to take on a risk that has absolutely no ceiling, like a risk that could theoretically cost you thousands or tens of thousands or even millions of dollars. Would you take that deal?
I mean, phrase like that, nobody takes that deal. It sounds completely irrational to cap your upside at $200 while, leaving your downside mathematically infinite.
Right. And yet, this exact exchange happens millions of times every single day in the financial markets. So welcome to this deep dive. Today, we are exploring the really intricate, high-stakes world of the short call option strategy.
It is a wild world for sure.
We've got a fascinating and honestly highly quantitative document today titled The Selling Call Option Strategy Guide. And our mission for this deep dive is to deconstruct why anyone in their right mind would take on that infinite risk, and how this specific strategy actually functions as the hidden engine driving modern market volatility.
Yeah, it's the gears beneath the surface.
Okay, let's unpack this. I know what buying a stock is. I buy a share, the price goes up, I make money. Simple. But this guide immediately dives into the derivatives market, specifically selling calls. Before we get into the massive market implications, walk me through the basic physics here. Like, what am I actually doing when I sell a call?
So, to understand the sale, we really have to look at the contract itself. In the U.S. equity market, a single options contract represents 100 shares of a stock.
Okay, 100 shares.
Right. And if you buy a call option, you are buying a choice. It's the right, but not the obligation, to purchase those 100 shares at a specific strike price by a certain expiration date. But when you are the one selling that call option, the dynamic is entirely inverted.
Because I'm the one taking on the obligation.
Exactly. You become the underwriter. If the buyer decides they want those shares, you are legally bound to deliver 100 shares of that underlying asset at the agreed-upon strike price. It literally does not matter how high the current market price has climbed.
Right.
Yeah. And to compensate you for taking on that massive obligation, you collect an upfront cash payment from the buyer. That is the option premium.
Okay, so the guide breaks this down into three different setups, depending on where the stock price is compared to the strike price. They call it moneyness. There's out of the money, at the money, and in the money.
Right.
I want to visualize the most dangerous version of this first, the naked short call. How does this actually play out in real life?
Right.
Like, let's say I'm looking at stock XYZ, and it's currently trading at $100.
Okay, let's run the math on that. Say you hold a neutral or bearish view on stock XYZ. You don't think it's going up. So you sell an out-of-the-money call with a $105 strike price. And let's say the buyer pays you a $2 premium per share because contracts are for 100 shares. That $2 premium instantly puts $200 of cash into your brokerage account.
And that $200 is it, right? That is my maximum possible profit on the entire trade.
That is your absolute ceiling. You will never make more than that. And your break-even point is $107. So that's the 105 strike price plus the $2 premium you collected.
Makes sense.
If the stock just drifts sideways or stays below 105, the option expires worthless and you keep the $200. It feels like easy money. But consider the alternative. Imagine a surprise buyout gets announced overnight and XYZ suddenly skyrockets to $130 a share.
Oh, man. So I'm legally forced to deliver 100 shares at $105. But because this is a naked call, I don't actually own those shares.
Nope, you have nothing.
So I have to go into the open market, buy them at the new sky-high price of $130, and immediately hand them over for $105.
Which means you lose $2,500 on the shares. You do keep your $200 premium, leaving you with a catastrophic net loss of $2,300. All just to make a measly $200.
Is selling a naked call basically like underwriting hurricane insurance on a beachfront house you don't even own?
That is actually a really powerful way to look at it. You're collecting a tiny premium to insure someone else against an event, which is the stock exploding upwards. But if the hurricane actually hits, you don't just pay for a few broken windows. You are on the hook for the entire value of a house that you now have to buy at the peak of a housing shortage.
Which is terrifying. I assume that's why the guide immediately introduces the second flavor, which is the covered call. This seems to be the strategy for people who want the premium without the infinite nightmare scenario.
Yeah, the mechanics change drastically when you actually own the 100 shares of XYZ stock beforehand. If you sell that same $105 call and collect the $200 premium, that cash acts as a buffer.
Right.
It reduces your cost basis on the stock from 100 down to 98. And if the stock spikes to 130 and the hurricane hits, your risk is fully covered because you already have the shares to hand over.
But there is a massive catch here. The guide points out that by doing this, you truncate all of your upside potential. Like, you get to keep the premium, and you make a profit up to 105, but you forfeit all that massive equity appreciation beyond your strike price.
Exactly. The stock went to 130 and you don't get to participate in any of that extra $25 a share. You've effectively sold your lottery ticket for a guaranteed small payout.
Yeah.
And for those who don't want to tie up the massive capital required to buy 100 shares but still refuse to take on the infinite risk of a naked call, the guide offers a third path, which is the bear call spread.
This one fascinated me. It's also called a credit spread, right?
Yeah.
How does buying another option fix my infinite risk problem?
It creates a ceiling. So you sell the $105 call and collect your $200, but simultaneously you take some of that cash and buy a further out-of-the-money call, say 110 strike for $50.
Okay, so my net credit shrinks to 150.
Right. But your maximum loss is now strictly capped. If the stock goes to 130, the bleeding stops at 110 because the call you bought kicks in to hedge the call you sold. It defines your risk, which makes it a highly capital-efficient way to trade.
Okay, that clears up the mechanics. But I'm still stuck on the underlying logic here. If the risk of a naked call is infinite, and a covered call caps all my upside, why is this such a foundational strategy for quantitative professionals? Like, why are massive funds structured around selling options?
To understand the motivation, we really have to look at the academic engine driving the entire options market, which is the variance risk premium, or VRP.
VRP.
Yeah. So in the options world, implied volatility acts as the market's fear gauge. It's the consensus estimate of how wildly a stock is going to swing in the future. But decades of empirical academic research show a consistent structural inefficiency. Implied volatility statistically overestimates realized volatility.
So wait, the market is consistently more afraid of what might happen than what actually happens.
Exactly. People are naturally risk-averse. Option buyers systematically overpay for insurance because they are terrified of extreme portfolio drawdowns.
Oh, I see.
And the option sellers are basically the actuaries stepping in to harvest that spread between the implied fear and the realized reality.
And to harvest that premium without getting wiped out, these professionals rely on the Black-Scholes-Merton model. This is where the guide introduces the Greeks. I've heard these terms thrown around on financial news, but it always sounds like impenetrable alphabet soup to me.
It definitely can be.
Let's break these down, starting with theta. The guide says theta is the seller's best friend. Why?
Because options are wasting assets. Theta measures time decay. Every single day that passes where the stock doesn't experience a massive spike, the extrinsic value of that contract melts away.
Right.
And as expiration approaches, that melting accelerates exponentially. If you sold the option, time is actively working to make you richer.
Okay, so if theta is the wind in my sails, what is gamma? The guide calls it the most dangerous risk for an option seller, but the math in here is dense. It says gamma is the rate of change of delta. I'll be honest, I had to stop reading there. What is delta?
Okay, let's take a step back. Delta simply measures how much the option's price will change for every $1 move in the underlying stock. If a stock goes up $1, delta tells you how much your option premium increases. Think of delta as the speed of your car.
Got it. Delta is the speed.
Which makes gamma the acceleration. Gamma measures how fast your speed is changing. When you sell an option, you hold what's called a short gamma position.
Meaning what exactly?
It means your losses don't just grow in a straight linear line if the market moves against you, they compound. As the stock rises toward your strike price, the position loses capital faster and faster.
So it's a tug of war. Theta is quietly dripping pennies into my bucket over time, while gamma is threatening to blow the bottom out of the bucket entirely if the stock suddenly moves. It sounds like picking up pennies in front of a steamroller. Is the VRP really a free lunch?
What's fascinating here is the introduction of the peso problem. Detractors argue that the VRP isn't a free lunch or a market inefficiency at all, that extra premium you collect. They say it is absolutely necessary compensation for unhedgeable black swan events.
Meaning, I'm just getting paid a tiny retainer to hold the bag for when the hurricane actually hits.
Precisely. And the return distribution of a short volatility strategy proves it. It looks like a long string of very consistent small wins, violently interrupted by sudden, extreme left-tail drawdowns that can wipe out years of profit in an afternoon.
Man, and even if you master the theoretical math of the Greeks, holding these contracts in live markets introduces incredibly messy, real-world operational hazards. The guide spends a lot of time on this. Let's start with the difference between American and European-style options, because this fundamentally changes the rules of the game.
It does. So, U.S. individual equities and ETFs are almost exclusively American-style options. This means the buyer can exercise their right at any point prior to expiration.
At any time.
Right. Broad market index options, however, like the S&P 500 index options, are European style. They can only be exercised at the exact moment of expiration, which entirely neutralizes the risk of early physical assignment.
That early assignment risk on American options creates a massive trap around dividend capture. According to the guide, if your short call is currently in the money right before a stock pays out its dividend and the remaining time value on the option is less than the dividend payout, a rational buyer is going to exercise early.
Yeah, the buyer happily forfeits a tiny bit of premium to capture a large cash dividend. But for you, the seller, this is an operational disaster. You are unexpectedly forced by the clearinghouse to deliver shares you might not even have.
Right.
Suddenly, you wake up with a short stock position, and you personally owe the dividend on those shares.
As bad as that is, the hazard that genuinely shocked me was pin risk and after-hours settlement. I want you to picture this scenario. It is Friday. The market is about to close at 4:00 p.m. The stock you bet against is trading at $104.99. Your strike price is $105. The bell rings. The option looks like it's out of the money. You think you've won the trade.
You haven't won anything yet.
Exactly.
The Options Clearing Corporation allows exercise instructions to be submitted up to an hour and a half after the equity market officially closes.
Which is wild. If an after-hours news headline drops at 4:30 p.m., say, a surprise earnings announcement or a CEO resignation that pushes the stock up to 108, the institutional buyer on the other side of your trade is going to exercise that contract.
Yep.
You went to bed on Friday thinking you kept your $200 premium, and you log in on Monday morning to find out you've been saddled with a massive unhedged short equity position over the weekend.
It's exactly why professional traders almost universally close or roll their short option positions before expiration. They just refuse to let it physically settle because the pin risk is basically a game of Russian roulette. And all of these hazards tie directly into how your broker manages your margin collateral. Because the risk of a short call is theoretically infinite, the capital requirements are punitive.
Right. The sources contrast two margin systems. There's standard regulation T margin, which calculates your risk in strict isolation. It basically ties up 20% of the underlying stock's value just to hold the position, regardless of what else you own. But then the guide mentions portfolio margin, calculated using the theoretical intermarket margining system, or TIMS. It says this stress tests the account across a multidimensional Monte Carlo risk array. That sounds like a sci-fi movie. What does that actually mean for a trader?
Simply put, a Monte Carlo simulation is just a computer rapidly rolling the dice on thousands of random what-if disaster scenarios. Instead of looking at your short call in isolation, it stress tests your entire portfolio.
Oh, wow.
Yeah, so it asks, what if the market drops 15% while volatility doubles and interest rates spike all at the exact same moment?
It's hunting for the specific combination of events that will break your portfolio.
Exactly. And because the system recognizes when your different positions hedge each other, it actually allows for massive leverage up to 6.7 to 1. But the catch is brutal. If there's a sudden intraday volatility spike, your account can plunge into a deficit instantly, triggering an immediate automated liquidation of your assets by your broker without any warning.
So if pin risk and margin calls are so devastating for regular traders, how are massive institutions managing to do this on a daily basis without blowing up the financial system? Let's talk about the market leviathans.
Well, a prime example of institutional overwriting is the BXM index. Launched by SIBO in 2002, it simulates holding the S&P 500 and continuously selling 1 month at the money calls against it. It's a massive, systematic, covered call strategy.
Right.
Historically, it does exactly what it's supposed to do. It lowers portfolio volatility and softens bear market drawdowns because of that constant premium income.
But it also creates what the guide calls bull market drag. Because the upside is constantly capped by those short calls, the BXM heavily underperforms the broader market during sustained bull runs. The equity appreciation is just repeatedly called away.
Right, you cap your wins.
But the BXM's the old guard. 1 month options are incredibly slow compared to what's happening now. The true market leviathan today is the zero DTE phenomenon, 0 days to expiration. These are contracts that expire on the exact same day they are traded. And according to our sources, these daily contracts now make up over 61% of total option volume on the S&P 500. Have zero DTEs essentially mutated a slow, methodical insurance writing business into high-speed financial sports betting?
If we connect this to the bigger picture, this shift has fundamentally altered the microstructure of the stock market and goes right back to our discussion on the Greeks.
Right.
In a zero DTE contract, theta, the time decay, is operating at its absolute maximum. But because there is essentially zero time left until expiration, gamma becomes explosive.
The acceleration we talked about earlier goes parabolic.
Yes. When retail traders and institutions flood the market buying massive amounts of zero DTE calls to chase intraday momentum, the market makers, the dealers who take the other side of those trades, are forced into an aggregate short gamma position.
And a dealer's job isn't to bet on the market's direction, right? Their job is to facilitate trades and remain delta neutral. So how do they hedge that explosive short gamma risk when the market starts rising?
By buying the underlying index futures. As the market rises, dealers must aggressively buy the underlying asset to hedge their books. This creates a violent positive feedback loop, a gamma squeeze.
Wait.
Their buying forces the market higher, which inflates the delta of the calls even more, which forces them to buy even more futures.
So it's like a thermostat that's wired backward. Instead of cooling the room down when it gets too hot, it accidentally triggers the furnace, which makes the room even hotter, which triggers the furnace to pump even more heat.
That is exactly the mechanism. Standard manual hedging is completely obsolete against the velocity of zero DTE gamma. Sub-millisecond risk analytics have replaced end-of-day reporting. A naked call seller caught in one of these intraday squeezes is facing catastrophic losses driven purely by mechanical dealer hedging, not fundamental news.
Okay, so a trader successfully navigates the theoretical math, they avoid the operational pin risk, and they survive the high-speed algorithmic gamma squeezes. They still have to face their absolute toughest opponent, the IRS.
Oh yeah, the IRS. The tax web surrounding complex options is notoriously intricate. The U.S. government heavily scrutinizes these trades under the straddle rules to prevent tax avoidance.
The logic here is fascinating. If you hold a stock and write a call against it, the IRS views this as an offsetting position, or a straddle. Because you've reduced your risk, they hit you with a severe punishment. They immediately suspend the holding period of your underlying stock and defer any losses on the option. You can't just write off the loss against your ordinary income.
However, to accommodate standard investment strategies, the IRS provides a critical safe harbor called the Qualified Covered Call.
The QCC.
Right, the QCC. To get this exemption, your option has to meet strict criteria, mostly that it has more than 30 days to expiration and isn't deeply in the money. If you follow the rules, your stock's holding period keeps ticking toward that favorable long-term capital gains tax rate.
Yeah. But the guide highlights a trap hidden in these rules, the protective collar trap. And the irony here is just painful. Let's say you set up a perfectly compliant qualified covered call, but then you decide you want to be a responsible adult and hedge your downside risk, so you buy a put option on the same stock.
By doing that, under Revenue Ruling 2002-66, the IRS instantly voids your safe harbor exemption and drags you right back into the punitive straddle rules.
They essentially penalize you for trying to be too safe with your risk management. I'm genuinely bewildered by this. You buy a protective put to lower your risk, and the government treats you like you're executing a malicious tax dodge?
It is deeply counterintuitive for a retail investor, I agree. But from the perspective of the IRS, by buying the put, you have substantially diminished your risk to the point that it no longer qualifies as a conventional investment position where your capital is actually at risk. They just view it as a pure tax deferral mechanism.
The IRS,
Yeah.
or good risk management, goes to get penalized? Well, we have covered incredible ground today. We started with the concept of being handed $200 to take on infinite risk. And we've seen how the short call strategy ranges from the mathematically unbounded terror of the naked call to the steady yield generation of institutional covered calls like the BXM.
We unpacked the theoretical tug-of-war between theta and gamma, the very real operational hazards of after-hours settlement, and the sheer market-moving power of zero DTE dealer hedging.
So if you are listening to this and thinking, I just hold basic index funds in my retirement account, why do I care about derivative strategies? Here is why this matters to you. It explains why your standard, boring stock portfolio sometimes experiences seemingly irrational, violent intraday swings. You might be a long-term investor holding a stock, but you are swimming in waters dominated by these high-speed derivative currents. When dealers are forced to furiously hedge explosive zero DTE gamma risks, the underlying stocks get thrown around in the wake.
Which leaves us with a critical structural question to ponder. We've established that zero DTE options now account for the vast majority of index volume. Retail and institutional traders alike are utilizing these daily contracts to speculate on volatility rather than invest in companies.
Right.
If the sheer volume of this derivative trading is what dictates the intraday movement of the underlying market, what happens to the broader economy? Are we approaching a future where the actual business performance of a company, its earnings, its products, its leadership, no longer dictates its stock price?
A market entirely decoupled from corporate reality, driven only by the mechanics of these derivative bets.
Exactly. We have to ask if the stock market is transitioning away from a mechanism for capital allocation and mutating into a pure derivative casino where the underlying companies are nothing more than abstract ticker symbols used to settle bets. Is the derivative tail now completely wagging the equity dog?
That is a staggering thought to leave on. The next time you see the market suddenly surge or drop 2% in an hour with absolutely no news headlines to explain it, remember the mechanics we talked about today? Remember the dealers trapped in the gamma squeeze, the thermostat wired backward, and remember the core proposition someone out there collected a $200 premium and the hurricane just made landfall.